Good morning, everybody.
Morning.
Good morning, Melinda. Hey, Matt. Hey, Danny. Good to see you. Good morning, Cherise. Good morning, Ryan. Hey, Nicole. Hey, Ivan. Welcome. We got Ben joining. If everybody wouldn't mind just putting in the chat where you're joining from this morning. Be interesting to see where people are coming from. Good morning, Chicago. Caleb, welcome. NYC, Dubai, up late, or maybe it's not too late yet there. Welcome.
Hey, Henry. Thanks for joining us, Vancouver.
All right, we'll get everybody in here. And let's get started. So I'll throw it over to you, Sharon.
Absolutely. Thank you. Thanks, everyone, for jumping on. I think a few more will just kind of join us as we go. So it's February 1st, 2023. The topic on everyone's mind right now is economic downturn and doom and gloom, and how am I going to manage this as a CEO? I need to raise some capital this year, and how's that going to happen? So hopefully, in this hour, we can help you navigate some of that and get some of your questions answered. For those of you who don't know me, I'm Sharon Bassi. I am the program manager at Fulcrum Venture Accelerator. We focus specifically on pre-seed and seed level companies, helping you learn everything you need to learn about raising capital at the VC level. Our next cohort is beginning at the end of March, so just next month. It's around the corner. So if you have any questions about that after the event, feel free to ping us, and we're happy to fill you in. Our guests today, Dylan Robbins from Lucra. He's based out in New York, multiple time founder, Lucra Sports, and previous to that, he has done some stints with Goldman Sachs and AQ Capital in Connecticut. Simon Sokol, thank you so much for filling in for John Albright from Relay Ventures in Toronto. Simon is also the co-founder and general partner at Gambit Partners, which is a VC and private equity firm, and a board observer on a handful of companies. So thank you, gentlemen. Really appreciate you joining us today. I'll pass it back to Will.
Yeah, thank you, Sharon. And just a reminder for anybody who is not one of our panelists, please mute your audio so we get the best audio for everybody. I'm Will Sachs. I'm the founder and CEO of Fulcrum Venture Accelerator, and I am going to be moderating our discussion today. Yeah, great. Thank you. So let's kick it off with you, Simon. Maybe you can introduce yourself and your fund a little bit, just so people have some more context. And thank you so much for joining us.
Yeah, for sure. Great to be here. So my name is Simon Sokol. I'm a vice president here at Relay Ventures, an early stage venture capital fund, writing checks anywhere from pre-seed to Series A in North American startups, primarily focused in fintech, prop tech, transportation, and sports tech, but will opportunistically invest elsewhere. And then Gambit Partners is a pre-seed fund that I run on the side with a good friend of mine.
Great, thank you, Simon. And Dylan, love to hear.
How you guys doing? Thanks for having me. Calling in from cold New York City. Good to meet everybody. Thanks for having me. I'm Dylan. I'm the founder and CEO of Lucra. We are a peer-to-peer betting app where fans can bet directly with their friends instead of playing against the bookie or the house or a casino. We're all about social, fun, casual, and making it approachable for all fans. As Sharon mentioned, this is my third venture actually now, and my first in the sports sector, and I've really enjoyed it. It's been quite an interesting time, as I'm sure Simon's seen, as he mentioned, sports technology. It's really exploding right now, so it's been really interesting time to be in this industry. I'm excited to chat with you guys about today about fundraising and anything else that comes to mind.
Great, welcome. Well, let's dive in. I've heard this conversation from many of our founders, is just generally in this space. How has the landscape changed over the last 6 months? Has it changed? Is it different for pre-seed and seed versus later stage? So I'd love to kick that over to you, Simon. Like, what are the conversations that are being had inside, behind closed doors?
Yeah, so it really depends on what stage you're looking at. I'd say for seed stage and pre-seed, which I know is most of this call, I think there's some conversation around slowing pacing, but in general, venture capitalist investors across the world are as optimistic as ever, really. Like at the end of the day, we're investing in innovation and people, and that hasn't fundamentally changed. But we do think about downstream investors and their willingness to invest and have to work backwards from there a little bit. So I'd say like if you were doing, call it 3 deals a quarter, maybe you're doing 2 now. So there's a slight increase in the bar that you're looking to invest in, but overall, we're still very much in market and very excited for the years to come.
Cool. Do you guys have any has anything changed other than maybe just slight slowdown? Is there any other changes that you've made internally?
Yeah, probably like a slight reduction in valuation, but at the end of the day, most venture investors are price takers and not makers. And so if there's a couple term sheets out there, that's what you're competing with. But if there isn't other competitive term sheets, which is possible as other investors slow pace down a little bit, then that's where you might have a bit more control over price. But call it 20 to 30% reduction in valuation at this stage. I wouldn't expect anything greater than that.
Yeah. Cool. Dylan, what are your thoughts on this whole situation from the macro perspective?
Yeah, I think Simon said it right in that I don't think the macro environment should or will have such a dramatic effect on really early stage venture. I think he made a great point about valuations. I mean, valuations were just overblown. I mean, 2019 to 2021, it got out of control. And I think there are a lot of founders that took advantage of that and got lucky. They got to a quick exit or things worked out. There's a lot of people in difficult situations now that, probably raise it too high of a valuation and they don't want to raise it down round and they're kind of in between a rock and a hard place. And so I think it's a good thing. I think that, I think a lot of founders don't think enough about valuation growth and that growth story. And, the goal is that you continue to increase your valuation every round. And maybe you take a little extra dilution or you have a little bit of a slightly lower valuation at your pre-seed or your seed. That's not really relevant in the long-term success of your business, but it could have a major impact on your ability to raise your next round. And so, you'd rather own, I always say, rather own less of a big thing than all of nothing. And I think finding the right partner is much more important than the right valuation. I think the market just needed a reset. So I think Simon's right. There's going to be great investors investing in great businesses at early stage. I think we're at an interesting phase now. We just did our Series A last year, and now we're kind of coming into what do we do now? And it's definitely a different market for companies of our size and much more revenue focused, much more metric focused. You can't just pitch the dream anymore and expect people to give you $20 or $30 million of what's happening in 2020. And so I think that's also a good thing. And it'll just, but I think Simon's right. Depending on the stage you're at, it is a bit different.
Yeah. Can you talk through that valuation growth a little bit just for founders? Because that's a conversation I've had multiple times with our founders over the years is people want a higher valuation. They think a higher valuation is going to be quote unquote better for them and their company in the long run. But can you just break that down for everyone in the audience?
Yeah.
So people understand that?
100%. So I think when you're thinking about like seed or pre-seed venture, what matters most is how much money do you need? Forget about valuation. Like how much money do you need to get to the next milestone? Is it $1 million? Is it 2? Is it 5? Like really dig deep on that and always assume you're going to need a little bit more. I think I've made that mistake before. I think every founder's made that mistake before. It always costs more. There's always that thing that you don't expect. So you get
say
that number.
Like double or
Nah, I would say I like to add like 50%. So like, I think, and I've never actually done that successfully. Like I've always tried to get myself to add the full 50%. You end up adding like 20% because you don't want to, because we're about to get to the other part of that, which is you're trying to manage dilution, right? So you're like, I know that what my company is maybe potentially worth now. If I raise more money, I don't think I can fetch a higher valuation. So it's like a dilution versus how much you need. But start with how much you need, right? So it's how much money do I need? Tack on 50%. And then you go to the market, you see what's out there. And frankly speaking, for round numbers, if you raise $2 million at a $10 million post-money valuation, that's probably a lot better than raising $2.5 million at a $20 million post-money valuation. Yes, you're going to have less dilution right now. I mean, maybe you have some incredible metrics. And again, every company's different. Like if you're on a rocket ship, take the rocket ship and grow. Most companies at our stage or at seed stage, they're figuring it out, right? They've got a vision, they've got a story, they've got some investors that like that story, but you haven't really proven the insane growth yet. And so think about the next round. If you do that 2 million at 10 million and things go okay, maybe you can raise 5 million at 25 million. But if you raise the 2.5 million at 20 million and things go okay, it's really hard to raise the $5 million at 25 million because that story doesn't look as good. You should be raising at 40 million if you've raised your first round at 20 million. So just leaving yourself room to grow understanding that bridge rounds come around. You may have a 6-month period where you need more capital. You have to raise some money in between. And so I just think like being conservative at the beginning is good to a point. I will say the other side of that story is dilution is hard. It hits you like a ton of bricks, a lot more than you expect it to happen. Like with safe notes, they get stacked on top of each other. All of a sudden you wake up and half your company's gone. Like that is a feeling that happens. And so you do want to like play that map out and say, okay, if I raise 3 million today, when am I going to run out of money? When am I going to have to raise more? Like how many times do I think I'm going to have to raise to get to profitability? And like understand the decision you're making, it has ripple effects. So it is like a balance between those.
It's like a kind of a tightrope to walk.
Yeah.
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 And the kicker there is if you raise 2 on a 20 and then you go to raise more money and you have to do a down round, well, then that could be even more painful on the dilution.
Totally. And I'm intrigued to hear Simon's thoughts about this because right now should be a market where a bunch of people are raising down rounds. But everything I'm hearing is everyone's raising flat rounds. No one wants to raise a down round. Everyone's being like, oh, we're just going to raise at what we raised our last valuation at. And I think that's probably difficult for investors because when you look at the multiples, you look at the metrics, it's like, well, you raised at an excessive valuation. We should bring this back. But down rounds, like they can cripple startups. It's like a signal that is hard. You know, it needs a massive product market fit shift to be able to turn that around. So I don't know, Simon, like, how do you view that? And like, when you see a company with a down round, does that excite you in any way? Because it looks like a value opportunity, or is it always like a negative signal? Because we obviously think about this, all founders.
So before I answer that question, I'll say from our perspective, there's really 2 ways that startups fail. One is that the founders give up for whatever reason, or the other way is that you run out of cash. And so assuming everyone here has no interest in giving up anytime soon, it really comes down to cash preservation. And if you raise at a valuation that next round isn't interesting for any investors, then that's a key way that you run out of cash. And so raising at reasonable valuations is kind of the key thing that you should be doing throughout. And at the end of the day, if you reach venture scale and have more dilution than you otherwise would want, it'll still be a great scenario. But the situation where you're uninteresting to investors because your capital structure doesn't make any sense, that's the highest probability of kind of a zero type of outcome. So that's the general thought there. And then on down rounds, for a lot of investors will just avoid down rounds at all costs, partially because they're doing their fellow, like other investors in their network, essentially a disservice, like marking down those companies. And so a lot of investors are trying to play this like very interesting long-term game with each other. And so they try to avoid that. And then the other thing is, if you have a lot of employees with options that will be underwater, if you raise at a down round, then you can start to see this really negative spiral occur within the company. And so oftentimes it might be better off for an investor to just invest in a brand new company, a very clean cap table, and kind of start fresh. But there definitely are situations where we've done down rounds in the past, but there's definitely a preference towards flat rounds. What we're seeing now a lot of time as well is structure is starting to emerge. It's no better than a down round, and investors are very knowledgeable with the fact of the structure in that cap table, and so future investors may not be willing to invest in it for that same reason. The only thing that's missing from there is that majority of employees don't fully grasp the negative effects of structure on top of them on the cap table, and so might not be as motivated to kind of leave the company and kind of create that negative spiral when there's structure versus a down round. But to any future investor, they're very similar.
Yeah, so the story is kind of, I guess, for the entrepreneurs on the call, it might be, hey, we recognize that there was a bit of a frenzy and some euphoria with our last round, that the valuation was a little high. We're keeping it at the same valuation. We're doing a flat round now that we're in a different environment. So we're just cruising into this next round, but it's at the same valuation.
Yeah, and
if you can.
It can work. And let's say like you've 2x'd over that period of time, but the multiple contraction happened at 4x, then the flat round seems like a pretty like expensive scenario for a lot of investors. So they might not be willing to do that. It might be more willing for an insider round to happen at a flat round versus fresh new capital. But that's essentially what's being figured out right now, somewhere between the Series A to late stage investing.
Yeah, you read my mind. What I was going to say is I think that we're seeing a lot of that now is obviously the people who are most motivated to help you are the people who have already invested in you, right? And so they know the business, they see the inside story, they understand that maybe you raise it too high a valuation. Like, okay, well, we'll do a flat round to like reset almost that this is where the valuation maybe has grown to, and that gives you some more runway to then go and hit those metrics to then bring in external investors. So that's why picking your early investors is so important, because you want someone who's going to really back you till the end.
Yeah. I also want to just highlight what you said, Simon. You basically said raising at too high a valuation can kill the company because it can make it so that there has to be a down round, or that raising new capital is not going to be possible. And so that it's actually like a way to kill your company.
Yeah,
Yeah.
100%. And especially through COVID, what we saw was way too many companies look at fundraising as a very transactional thing instead of finding the right partner to be on the journey with. Like these are 10+ year relationships typically between an investor and a founder, which is actually longer than the average marriage. So it's pretty interesting that through that period of time, people were willing to hop on a call within 30 minutes, find a lead investor, but obviously typically taking a bit longer to find kind of their life partner. So we really push our companies to do things slowly, build relationships over time. And it's a big reason why we at Relay will start talking to companies at the pre-seed when typically we're doing seed stage investing, because we want to build that relationship over a 6 to 12 month period before we really have that conviction to invest in many cases.
Yeah.
I say, well, that's one thing we both didn't talk about, but kind of alluded to, that has changed a lot, is how long it takes to raise. I think is a lot slower now. Like we're about to gear up for another raise soon, and we did our last one, I think, in 10 weeks. And this one, I think we're going to leave 6 months for, just because it's just not that our company's doing well. It's just people ask more questions. They want to go slower. We want to go slower. It's a bigger commitment now. So I think that's just like a painful realization for founders. It was already a slow and painful process. I think it's going to get more slow and more painful. That being said, to Simon's point, if you can find that right term sheet or that right, you can spur the process along. Like at some point, it's slow, and then it starts. And then it's like very fast from there. But I think the diligence phase is going to be a little bit lengthier this spring and summer.
Yeah, 100%. And if you like someone like Relay as an example, we do seed investing, but also we'll follow on and lead Series A's. And so for us, we come to our companies at Series A and we're like, hey, you can go out to market and spend 6 months fundraising, or you can take this term sheet, which probably isn't at the highest valuation possible, but it's still a significant valuation, and it's very fair, and it avoids that 6 month fundraise process where instead you can focus on building the business and ultimately get to a higher valuation in the future.
Yeah. Time is money. Like we did that exact thing with our Series A. We got a term sheet from one of our seed investors who we loved, and it was probably half of what we could have gotten in the market at that time. No exaggeration. The market was out of control at that time. You could have raised it like $100 million with an idea if you had the right momentum. And we said, look, this is A, more fair and going to be better for this valuation growth story for long term, and B, it will save us 6 months more. And that time was valuable. We got to build more product faster. We got to hire more people faster. And it's hard to like look at the competitors and see like, oh, everyone's raising these crazy valuations that are out of control. But I think that a lot of folks are feeling the opposite pressure of that now. So I think
they're like, shit, we raised at this. Yeah. Oh my God, how did we raise at that valuation? Now what do we do? So
right. And valuations will correct up a little bit. It'll take time, but like we'll end up somewhere in between probably over the next 5 years. But the next year or two is going to be depressed.
Yeah, I was I was in the startup world in 2009, 2010, and then also through COVID. And I saw when the doomsday predictions start coming, everything drops, and then people kind of pull back. They're like, wait, what's going to happen? And then it seems to come back slowly over the next 12 to 18 months. Yeah. So it feels like we're, right, barring who knows what's going to happen next, but it feels like we're in that kind of reacclimation. Yeah. People are getting comfortable with normal kind of
stuff. But to Simon's point, like, and I think one thing that also was a ramification, like a positive ramification for founders of the crazy bull market, was a ton of funds started, a ton of funds raised new funds. Everyone raised a crap ton of money, and they have to deploy it, right? Like you can't just sit on your hands, right, Simon? You got to invest this money sometime. And so for the right companies, it's still there. It's just at lower valuations. It takes longer, but like the money's still going to get deployed. So it actually should be a good couple of years for new ventures to come around. It's just going to be different how it all happens. I don't know if that you feel the same way, Simon.
Yeah, I definitely feel the same. The only caveat to that is that, especially through COVID, we were seeing like the pacing of funds get crazily contracted to points that made no sense in terms of like investing in a portfolio and building a diversified portfolio, where they were investing in, call it 30 companies over a year, where it should have been over 3 to 4 years. So now they're stretching the funds that they raised during COVID or before COVID to last longer. So that's essentially the only kind of reverse push towards the need to actually invest capital. But 100%, Dylan's right. Like funds their job is to invest capital into companies, and so they'll continue to do that at a slower pace than they were before, and at more reasonable and fair valuations. But at the end of the day, that's what they get paid to do. So.
Yeah. What would be your number one piece of advice, both of you, to a founder of a seed stage or pre-seed stage company that's maybe raising their first round, or they've raised a small round already and they're raising their first pre-seed round? What would be, maybe they've got like 6 months of runway or 4 months of runway right now. What would be your counsel to them?
Yeah, I can kick that off. I'd say the first thing is to treat the pitch as a two-way conversation. It's not this interview process where the investors are interviewing you and deciding if you're right for their portfolio. It should also be the reverse, where you're trying to figure out if they're the right partner to go on this long journey with, and that takes time. So the earlier you can start that, the better. If you have 6 months left, then there is a bit of a power dynamic that swings towards the investors, just because you're running out of cash, and typically those businesses are unprofitable, and there's really not much that not a real lever that you can do there, other than basically stop paying a lot of those variable costs that are pretty important to your business. And so starting early, really widening your aperture of investors as much as possible, really just to talk to anyone that potentially could fit your world. And so I wouldn't bother talking to investors who are like focused on industries that have nothing to do with you, but if they fit your stage and they fit your industry, like, you should find ways to get in front of them. And there's tons of really high quality strategies to do that.
Yeah, I think, my thoughts are in a similar line of thinking. I think number one is quick no's are your best friend. I think the last thing you want to do is spend 3-4 meetings, hours with a venture capital firm, and then find out that they're just not interested in your industry, or they're just learning, or it's not a fit. Like, push them early on to just give you a view, and are they interested or not? And you can use whatever leverage you have to do that. So I think quick no's are your friend. Two, I think Simon's point is right. Like, you got to cast a wide net. I think for our seed round, where we ended up closing, I think 22 unique investors, we spoke to like 250. So it's like a 10% hit rate for us. A lot of it, we were in the gambling space, so there's a lot of sin and vice clauses, again, where I learned 2 or 3 meetings in that they couldn't invest legally. It's like, that would have been good to know on meeting number 1. So I now ask that question as like in my intro email if I'm talking to someone. And then I think number 3 is a little bit different, but once you raise a round, I would recommend trying to put in together some sort of debt facility if it makes sense for you. I think, to Simon's point, runway leverage is a big stress point in raising. And if you have a revolver or a credit facility or any sort of thing that you can borrow against, even for a month or 2, that you hope to never use, it's pretty cheap, and it expands your leverage to allow you to not have to like take that term sheet you don't want because you're running out of money. But to Simon's point, the earlier you start, the more leverage you're going to have. You want to be raising when you don't need to raise, is the ideal situation, but I'll tell you from experience, it never happens that way. It's like you're at that point, you're focusing on growing the business. So those are going to be a couple pieces of advice.
Great advice. Yeah, the other one I would add is, if you've got, and Simon, you kind of touched on this, if you've got multiple buyers, if you're running a process where you can engineer it so you've got multiple buyers or multiple term sheets, then the leverage starts to shift from, if you've only got one term sheet, you don't have many options. Somebody once said to me, in sales, if you've got one buyer, you got no buyers. And that stuck with me. So that's another piece of advice.
Yeah.
What are you guys most excited about in the world of technology right now? Dylan, maybe throw that one to you.
Wow, that's a big question. Most excited about in the world of technology. I guess I'll go more to my space, which is in sports technology. I think, yeah. I'm
being on the call.
Sorry, somebody.
No worries. No worries. I think I'll go to my space in sports technology. I think for me, the proliferation of social media and the proliferation, like the digitization of where people consume sports, I think is very exciting. When I talk to most of our customers who are millennials, Gen Z, they don't watch TV, they don't watch full games, they consume sports on Overtime and Instagram and Snapchat and TikTok. And it's really interesting because it's not how many of my friends do it, and that's our customer. And so it's very, I think there's a lot of interesting change going to happen with all the media rights and TV rights and streaming. And I just think there's a lot happening in general in that world that's very interesting. And how gambling is going to come into it for us is, I think, a big factor. So I'm watching that closely and trying to align ourselves with brands where our customers are engaging. We don't do traditional cable TV ads, right? Because like that's not where our customer is. We're trying to partner with TikTok influencers who are discussing highlights of games, right? Because that's where our fans are.
Yeah, no, that's great. And the one other thing that I'll add that is something that I'm personally very excited about is just like this return to technology as like legitimate differentiation and in a true moat. Like for a large portion of this bull run, the ability for a founder to execute and tell an amazing story to venture investors is what was able to get them funded for years. And now, for whatever reason, we're kind of getting back to the roots of what venture capital is, which is investing early as a financier into startups and helping de-risk the technology of the business and help them grow over time in more of a milestones driven approach, which was basically lost. Like that art was like truly lost for the past 5 or so years. And now we're like more than ever, I'm seeing startups that are like, this is what makes our technology unique. And this is how we're going to use that to differentiate in the specific industry over time and slowly grow to larger and larger industries. Whereas before it was like, whoever could tell the best story and get however many investors excited as possible, get as many term sheets and create this like real FOMO dynamic, which really wasn't healthy for anyone in the industry.
That feels like a nice pointer for for everyone in the audience is to focus more. If you have technology, if you're building something proprietary, focus on it and tell that story more, because that feels more enduring in all markets than maybe the hype or whatever, what was a year and a half
like if you
ago.
think about it, there's two real buckets. There's technology risk and there's market risk. And so the less technology that exists in a business, the more market risk inherently is there, in the sense that if you don't have a true technology moat, then more competitors can come into the space as you prove out that there's a real business to be had there. Whereas if you have a true technology moat, a competitor that wants to join simply can't, because they can't build the technology you can. So less tech just means kind of more competition is likely to happen.
Yeah. Dylan, do you have any thoughts on that?
Yeah, I agree with that completely. I think that the more you can prove innate value in your business, the better. That being said, I think we'd be lying to ourselves if FOMO wasn't part of this thing. I think it is a little bit of a game, raising money. Like you have to play, and if you're not willing to play, other people are playing, and so you have to be willing to talk to everybody, kind of like make sure that folks know you're talking to other people. But investors are smart, like they can see through it. If they people talk to each other. Simon knows all the other investors investing in his space, but if you can create that buzz, it can really work in your benefit, because when they go check in with those other investors, like, oh yeah, we're talking to Lucra too. It's like, oh wow, this is even if it's not all the way there yet, just it helps get that building momentum going. So it's a balance. I think you gotta, obviously your company and what you're building is most important. But there's a lot of great companies, and so if you have to play that game and leverage that to create that energy around your product.
Yeah, that was something I kind of learned haphazardly when I was building Kindara, was that when I started, I thought you build something compelling, you make a nice slide deck, and you go show it to some investors, and they say yes. And then what I learned is that it's a whole process, and if you skip steps in the process and you don't have multiple people interested, it just gets a lot more difficult. And Simon, on your side of the table, like you probably like deals that aren't that competitive, where you see something and you can get it at a good price. But what are your thoughts on that?
Yeah, like on the one hand, entry price matters. On the other hand, the vast majority of investors look to syndicate with other investors. And so if no one else is interested, then it's really tough to pull around together. So that's a bit of the dynamic that you're playing with. But venture capital really is about this like power law dynamic, where very few companies generate the vast majority of returns in the industry. And so to get fussed up over entry price to like too much of an extent is actually a net negative for any fund to do. So of course, you're focused on entry price and it's important and affects the ultimate returns of the fund. But the idea is to invest in the best founders, kind of targeting that problem in big markets that can generate venture scale businesses. So typically defined as like $1 billion outcome, so 100 to 200 million per year in revenue. So you're looking for these massive markets. And then from there, it's like, is this one of the 3 founders in the world that you think can solve this problem? So that's really what you're working with. And a lot of investors similarly think that way. So if you find this amazing founder, you're probably not the only one who's found them, but ideally you can get to them early through some strategies, and doing like what we do at Relay, like getting involved at the pre-seed is a good way to do that. But more and more funds are moving earlier and earlier to have that same sort of advantage.
I think it gets back to what you were talking about earlier too, with like valuation and ownership. if you're looking for $1 billion outcome, your seed round being at 15 or 20 million is irrelevant to that outcome for the investor. Like it's not going to make a difference. But what the investor cares about is like ownership. They're doing the math long term. Like, is this going to return the fund math? If we hit it big, can I make enough money? Like, I think the fund math dynamic of this whole thing is something I knew nothing about before I raised money. I just thought venture capital firms invested in businesses and they want to see them succeed, which is true. But they are playing the math of like, okay, I'm going to invest in 30 companies and maybe 2 are going to be $1 billion outcomes. So the ownership percentages of each investment matters, right? And our investors check in with us every round. It's like, well, okay, well, what's my fully diluted share count now? And they're kind of tracking that along the way. So I think that's probably where the valuation stuff comes from. It's less about not wanting to push your valuation down or up at this moment. It's playing the long game for the fund return.
Yeah, it's 100% right. And something most founders don't know or don't fully understand, like when we invest in 30 companies, if 28 completely fail and go to zero, but 2 are these like massive outlier outcomes, that's an amazing fund. And that fund you can use to raise future funds and deploy that same sort of math. So while we try to ignore the ones that don't work, obviously it's kind of harder to do than is actually possible, because like you're working with founders solving like these incredible problems and you want to work with them throughout that journey and kind of be there for those crucible moments. But at the end of the day, it's those handful of companies that are going to make the difference. Sometimes It's hard to tell which ones those companies are. But yeah, it's pretty wild math when you look under the hood.
And I would also use that as another example is like, not every company is built the same, right? So my first business was a bootstrap business, cash flow right off the bat, service business, was never going to be $1 billion company, had no chance to do that. And so we were like, we should not raise venture capital. Like any venture capital firm is going to want us to grow and be that potential big outcome. So we raised from some angels, we raised from people in our industry. We did a couple maybe smaller firms that understood that maybe M&A, and we actually just recently sold the business. And so the M&A outcome was a win for everybody. They didn't need it to return their fund. Lucra, obviously we're shooting for, the big shot, and, we took on venture capital. And that being said, we are in a very acquisitive industry. So we were very clear with our venture capital firms, if DraftKings come along and wants to buy us in a couple of years, that's something that we would like to do, right? And so I think being proactive about that and explaining that where your kind of view of where the company is going, it does help, because it will help you get to those quick no's. Because some funds will say, well, that's not for us, we're not looking for short-term M&A. But some folks will say, hey, that works well in our portfolio, our strategy is a little bit different. So I think just being it's a little awkward, but being forthcoming about that is important.
Saves time.
Yeah, it saves time.
Do you have different metrics, Simon, for Relay versus your own fund, which I assume is a smaller fund? Do you need a bigger exit, and do you think about that?
Yeah, so the smaller fund you are, the easier it is essentially to generate kind of massive multiples on that fund size. And so one of the cool parts about being a really small fund, so the pre-seed fund I run is a $2 million fund. We're running 50K checks. So in theory, I could invest at the angel or pre-seed stage and actually sell in secondary at the series B or C and return the fund like that. So I don't need to wait for a true liquidity event, typically defined as like an IPO or an M&A. Where at Relay with a $150 million fund, you need these massive liquidity events to happen. So you have to really be in that company for a long time and allow the value to compound, which is kind of the core key difference. So we're definitely less focused on ownership when it comes to Gambit versus Relay. And then we're also less focused on governance. So at Relay, we're typically always looking to have a board seat or observer seat, really so that we're in a position to have a unique advantage to lead the Series A and basically have that information asymmetry that you wouldn't get if you were a net new investor.
Yeah. I think that's a great point for founders to understand, is if you're raising from angels, some angel might be stoked with a 4x or a 5x. But a big multi-$100 million venture fund is just, from the dynamics of needing to return the fund with every investment, it's not going to be an option. So just double clicking on that. All right, so I'd love to take some questions in a minute, but we call this event Myths and Truths about how to raise during an economic downturn. So I'd love to throw that back to each of you, maybe for a myth, one myth and one truth, if you have two.
Yeah.
What do you think they are for 2023 for founders who are raising seed capital?
I think we covered them. I think the myth is that it's a recession, it's impossible to raise money, wait on the sidelines, wait it out. I think that's the myth. Don't wait it out, start earlier, I think is the answer for that. I think anyone waiting it out is going to put themselves in a difficult leverage situation over the summer for, with runway. And I think the truth is that, you got to just accept the fact as founders that valuations are lower. And even if we raise money earlier, we got to just acknowledge that and deal with that and take that in stride. And so I think that the whole waiting it out for the valuations to rise is not going to happen overnight. So the truth is, like Simon's point, you should look for 20 to 30% depressed valuations and just kind of live with that.
Yeah, and the only other myth that I'll add there is just around all these venture funds saying that they're in market. I unfortunately, a lot of them are not in market. So let's say they had a 3-year fund and they deploy 90% of it, like they're not going to pace like they previously were. And so they'll take those pipeline meetings and make it seem like they're still interested in investing. But at the end of the day, like, they're not going to go to their LPs and call capital because they just spent the past year or two over investing at ridiculous valuations, and their fund is in big trouble. And so I highly recommend you ask them basically like, when was the last time that you invested, what sort of companies, what sort of stage, valuation, etc. Just get a sense of like whether or not they're actively in market. Because if you ask them, are you in market, they'll say yes, but I really implore you to dive a little bit deeper there.
That's so powerful. So the key question is, when's the last time when was your last investment? Yeah.
And how did you do it? I think, we saw a lot of like warehousing of investments over the last couple of, 6 months and year two, where like folks, the fund, they don't have money from the fund to invest, but they really want to back the company. So they'll warehouse that somewhere else. They'll take money from the founders, like, and back it. And that's a good signal when they're willing to do that. It's like, wow, they really are committed to your business. But I think to Simon's point, I think it's definitely, as tough of a market it is for founders, it's tougher for funds in raising money at times as well. So I think it's a great point. Like talking about quick no's, like figure out if there's even ability for them to invest early on, because you don't want to go all down that process and then find out that there's not money behind that.
Yeah, and one truth, not about fundraising, but about the market that really excites me, has to do with layoffs, which is like a horrible thing that's happening in big tech across the board. But what it means for startups is there's amazing talent available, and they're no longer comping to what they were able to get when they were working at Google or Facebook or any of those big tech companies. Like for the first time in a really long time, you can hire amazing talent for fair prices. And so that's what makes these markets, like same thing as in 2008, a really strong opportunity for startups to win versus these large incumbents, because they have talent now. And that real density of high quality talent is a thing that makes these small startups be able to beat these Goliath companies.
I love that you brought that up. That seems so important, because if you take fundraising out of the mix and it's like, what's the key to building an incredible company that differentiates itself and succeeds? It's the people, it's the team. So that is now available. A lot of these people who have been laid off have the skills that our founders will be looking for. What about you, Dylan? Truth? Any other truths?
Yeah, I think to double down on Simon's truth, which I think is correct on the hiring market, is it really shifted, right? So as a founder of a seed Series A company, we were in an exciting space, we had an exciting idea, and it was just hard to find people from Google to come and work for you, right? We couldn't afford those people. We still can't today. But I think it actually helped us look outside the box. Like, we have an incredible team across the US. We're a remote first company. I would urge you, just because COVID is not over, don't fall away from, just because COVID is ending, don't fall away from remote. Remote is a really powerful tool, especially on the engineering side. We have some amazing engineers from across the country who aren't in New York City, who aren't in San Francisco, that have been fantastic for us. And to be honest, I wouldn't trade them for the world. And I think now the market has changed and it's more of an employer's market. And we're going to stick to our guns. I don't think we're going to pivot and just go hire a bunch of engineers from New York City and San Francisco. We've kind of found a strategy that works for us. So I think that, kind of keeping that truth, I think, has remained the same for us.
That's a great one. Simon, has your views on remote teams changed at all over the last couple of years, going through COVID and everything?
Well, before COVID, I thought it was very unlikely for most companies to succeed in that remote culture. Like having that density of people together and just being that serendipity that happens is pretty magnificent. But what happened through COVID is people had to figure out a way to kind of spur that serendipity even through kind of the Zoom calls. And for us, this call right now feels totally normal, where in 2019 it would have been the most bizarre thing. So it's definitely changed. Majority of our companies are probably like mostly in person. A lot of the developers are remote still, but there's some hybrid model which has its own difficulties, honestly, with that. So we see a mix. It's really about what works for the company, and no matter what path you take there's work to be involved. Like asynchronous remote work is very difficult, but if done right, can be amazing. But that done right piece is pretty critical.
Yeah, great. All right, I'd love to take some questions. If you've got a question for either of our panelists today, type it into the chat. And Sharn, can I ask you to select some to be answered by our panel here?
Got like 5 or 6 on here already, 7, 8 actually. I'll kind of scroll up to the top here. Caleb is asking, how does a fund value enforceable IP outside of current revenue? So his Web3 infrastructure company has a patent filed for a technology that all major tech companies will need to use in the future. Over the last 12 months, we've generated 1.5 million in revenue. So there's some multiple for that. But how does the IP that isn't currently generating revenue, but will be factored in? So how do you factor in that IP?
I think it depends, to be honest. There's many companies where their IP is key to that business and really does create a true moat. And there's some where even if someone's infringing on your patent, you don't have the money to actually take them to court, and there's just not a lot you can do about it. So it's this really fine dance there. It's something that we look to have because it is a form of differentiation. But I wouldn't rest on your laurels as like that's going to be the thing that makes you succeed. At the end of the day, it's executing, getting users, figuring out how to monetize them, continuing to build up that business over time, and like hitting those key milestones to get more capital in the bank. But yeah, no, it's definitely a good thing, but it's industry dependent. Like hard tech, super important. Something more on the SaaS side of things, probably less important.
Yeah, I can just add to that really quick. Our current business has no patents. Nothing in our space is patentable. So even if we tried, like we looked at it, it's like every lawyer that we talked to was like, you could do this, but it's not going to be valuable. In my previous business, which is still going today, it's a wine bottle company, like tons of like hardware and technology patentable. And we like use it as the first line in every single investor pitch. Like we try to differentiate ourselves. That being said, you do get pushback, like in terms of like, okay, can you defend this? Is it really defensible? It's really hard to defend patents in today's world. So there's probably some value to it, but not as lean on the revenue, maybe more at this early stage. That's a great, that much revenue this early on. That's a great indicator, and I would lean in on that to start.
Great.
That's interesting. Thank you, gentlemen. John was actually asking something along the lines of early traction and revenue also. So, have you seen any change in that over the past year in what investors are looking for from pre-seed or seed level companies in terms of their revenue?
Yeah, pre-seed, not so much. Like at the end of the day, that's a founder bet. Like if that truly is, like you're making the bet that you believe that founder is going to be one of the top 3 solving that problem. Like it more or less is that simple. And like, of course, you want to be in a market that you think is big enough to generate that venture scale type of outcome, but that's what you're really playing with. In seed stage, it partially depends on the fund. Pre-COVID, I'd say like Relay was looking somewhere in the 5,000 to 10,000 per month in revenue. Through COVID, that got contracted in many cases towards 0. And then now it's probably somewhere in between. So that's still in flux to some extent. The benefit of having monetization is that it's the market telling you that the product is interesting to them and they're willing to put their credit card down to actually kind of speak on that behalf. But at the end of the day, there's many funds at the seed stage and sometimes even at the Series A that'll invest pre-revenue. But the vast majority, I think, now are looking for monetization more than they previously were.
What do you, in terms of the founder, answering that question, is this founder going to be the top 3 in the world in this industry over the next 5 to 10 years? How do you answer that question? Yes. What can founders do? What can founders do to prove that they'll be that person?
That like funds generally look at that question the wrong way, which many funds look at it the wrong way, is like, where did they previously work? Where did they go to school? Like, were they these like Stanford grad that then worked at Google? And it like, that's amazing. And like, there's plenty of funds to fund those people. Right? The way I look at it is much more like this Darwinian survival of the fittest thing. Like, what makes that founder like uniquely fit to solve that problem? Like, why have like, and that comes down to the genesis story, and we hear it on the first 10 minutes of any pitch. It's like, why did that founder quit whatever they were doing before and start this company? Like, there should be some clear catalyst event to make that happen, and like what makes them uniquely fit to solve that problem. But it can be like a wide range of things, and someone uniquely fit to solve one problem couldn't be a worse fit for another problem. So it really just depends on what they're actually solving, and their experience to date typically answers that question, but not always. They might have unique insight actually being outside of that market, but in the vast majority of cases, like they've previously been in that industry, they felt the problem, and now this is how they're looking to fix it.
Yeah. What do you think, Dylan, from the founder side?
Yeah, I mean, I think all you can do as a founder is just be yourself. I think like, you know, a lot of people get stuck in the wrong zone of trying to be something that they're not, or put on a fake, you know, fake face for investors. And, you know, if you're not talking to your investors like you're talking to your team, they're probably not the right investor. You're probably doing something wrong. And so I just try to be really lighthearted. It's who I am. And, you know, some investors didn't like that, right? They wanted someone like that was super, super buttoned up, jacket and tie. Like I would show up to a t-shirt and maybe throw the blazer on in meetings because that's who I am. And like, I want them to invest in me. And you know, I'm very passionate about our space, and you just try and get that across. And I think so Simon's right. And you're probably what's interesting is each fund probably would pick 3 different people for that to solve that problem, right? So you got to find the fund that's like that would back you.
Yeah. It's like I used to think fundraising was the most like sales, and then one of our mentors at Fulcrum said, well, I actually think it's more like dating.
Yeah,
which I think has merit too.
100%.
yeah.
Question from Matt Wampler. This one just piqued my interest. Relay is invested in a number of restaurant tech companies. I'd love to know what you're currently seeing or interested in that industry. Like, what is it in restaurant tech that you guys find interesting?
Yeah, so we look at some stuff doing back house, some stuff front of house. One of the key things that makes us unable to probably be as active as we otherwise want to be in restaurant tech is we will never invest in competitive businesses. So 7 Shifts and Touch Bistro, quite large businesses in the restaurant tech space. They cover a large portion of the industry. So it's hard for us to find companies that we're excited about and led by founders that we're excited about solving like a unique problem within the restaurant tech space, but they do exist. So one that we recently did was a company called Cookin, which is, it's almost like Uber Eats, but instead of connecting restaurants, it's connecting you to authentic home cooks, creating kind of whatever their meal is, that's like their specialty. So think like Nonna's like special tomato sauce that she's been making since like a little kid when she lived in Italy. Like that's what you can get to your home for the first time. So that's the sort of like unique innovations we're trying to find now in the restaurant tech space. There's still a lot taking place that has to do specifically with restaurants and the operations, but we're pretty well invested into that side of things.
Neat. I mean, I've had that business pitched to me like a couple times over the years, so I'm glad that's actually happening now.
Yeah, there's plenty of risk to it too, but we're excited about that one.
Cool. Sharon, any other questions there that pique your fancy?
Yeah, actually, Hugh is asking a question. He has a material tech enabled pickleball equipment startup, super hyper specific right now. And I've spoken with him before, and I know he's going to do great things as things go on. But right now he's curious about if anyone on the panel has any advice on raising a bridge round between the pre-seed and the series round, specifically around terms of C note for bridge. Should they match pre-seed terms or be slightly better?
Yeah, we kind of already touched on it, but yeah, what about the word bridge?
Yeah, I mean, like for me, the way I think about bridge, it's typically done by insiders, but not always. And it's like this intermediate round between like the classic seed and series A, or like whatever it might be. In reality, like there's seeds, there's pre-seeds, there's seed 2s, there's pre-As. Like the nomenclature is like a lot less important to us. But typically bridges are done by insiders, but not always. And then on convertible note, it really just depends how much you've grown and kind of how much the market has or hasn't contracted during that period of time in terms of whether or not that should be at the same valuation. But if you want things to get done quickly and easily and get back to doing what you love, which is building that business, then kind of flat to that round might be the best situation there.
Yeah, I would say using the word bridge is totally fine with existing investors because they know what it is, they know what's going on. I would probably avoid the word bridge with external investors. I think you can have negative connotations, whether that's right or wrong. You know, I like, you know, seed 1 or A1, or we're doing an extension, or we're adding on, or it's this exciting thing that we're doing for you to get in is important. With existing investors, you know, they're going to have all your information and they're going to know the story, and you can just be like a little more candid there. But I think terminology can make a difference. I think I think that's an interesting point on a small tangent that, maybe we made a mistake on at some point, is like naming your rounds can be risky. Like naming your rounds as pre-seed, seed, series A, like the market changed. Like where we raised series A before may have been considered seed at some certain times, or the market evolved. So I think from now on, we go out to raise money. Lucra's raising money. It's an exciting time to get involved in the business. Like, here's how much we're raising and why. We don't need to put a label on that necessarily. And investors can then, because you box out investors by saying you're a certain thing sometimes, and maybe they would be really interested in your business. So I vote like, don't name it unless it's pre-seed. Then it's just like, so early that's actually a good signal.
Yeah, I have the same advice, is don't use the word bridge. Generally, even you can usually avoid it even with internal investors, because I think it is risky and it can have a negative signaling effect. And so you can call it pre-seed, seed two. And yeah, I agree.
Or just say we're raising money. We're raising money.
And what another thing I realized, and we now teach, is that when you name your round, you're signaling the stage that you're at. And so if you're raising a $2 million pre-seed round, the bar is going to be lower than if you're raising a $2 million seed round, just with the name, because people are going to, in their mind, categorize that. So for everybody on the call, there's a little bit of finesse that's needed there. And I like what you said, Dylan, like, don't name it if you don't really have to. All right, we probably have time for one or two more, Sharon.
Yeah, a couple of people are sort of asking around crowdfunding. What are the thoughts from the panel? Does it make more sense to take that route right now?
Yeah, or other alternatives maybe to traditional venture capital.
Yeah, I think it depends. From my experience, crowdfunding typically hasn't been like a direct substitute for venture. In many cases, it's more like a substitute, or comes alongside like an angel round, like typically earlier. The one caveat that I've seen to that actually really excites me, and kind of for the future of kind of financing startups, is specifically focus on the consumer side of things. But let's say you have a Series A, it's 10 million, maybe you carve out 2 million for like a crowdfunding piece where you could have your users or future users buy into your company. Because I can promise you, if they're owners, they're going to be incredibly loyal to that business, even if the switching costs are low. So that's the kind of key caveat where it might make sense towards like a Series A or a B. But in a lot of cases, what we're seeing is if those later stage companies are raising like the bulk of their round through crowdfunding, they've probably already exhausted all the venture funds out there, and it has like a bit of a kind of negative signal there.
I think it's the perfect thing, depending on if your company is the right company. As we talked about earlier, like if you don't need that much cash and you don't want that crazy venture outcome, and crowdfunding can be faster, you don't have to deal with board governance. Like there's a lot of positives to crowdfunding if it's the right thing for you. But I think Simon's point is right. There's a cool company called Party Round. I think Andreessen invested in them at some point. And my buddy works there, and I think it's an interesting idea in that like you try and get people who are interested in your product, who could potentially be customers or like brand ambassadors of your business. And so for a consumer product, like maybe it does make sense to like have like, can I get free brand ambassadors out of that? But I think it's, pretty specific.
Yeah. Cool. Probably time for one more.
Sure. Aftech Services is asking, do you think a new MSP, managed service provider startup trying to move from break and fix to monthly paying clients can get funding? And where can one find funding if that's so?
I genuinely believe there's capital out there for any company, assuming that the founder is great and it makes sense why they're running that business. Like there is so many different types of funds out there, all trying to differentiate, or a good portion of them trying to differentiate. Some are doing it pretty consensus, and I think those ones won't be alive for as long as other funds that are actually looking to be a bit more contrarian. But yeah, there's plenty of capital looking for unique opportunities, but it's really just about finding those, which can be the toughest part.
Yeah. All right.
Yeah.
Well, we're gonna have to. Sorry, do you have one more, Sharon?
No, I was saying there's someone for everyone. Back to
Someone for everyone. That's right.
the dating analogy.
It's physics, law of the universe. Well, great. Simon, if people want to learn more about you, if we've got some of these founders on the call that are going to be the top 3 people in the world that building what they're building, how do they find you in Relay or Gambit?
Yeah, so Simon at relayventures.com is probably the best way. I'm also on Twitter at ssokol94, or you can find me on LinkedIn as well. Really, however you get in contact with me, I answer cold emails or whatever all the time. So just feel free to reach out.
What do you like to see in a cold email?
Keep it like pretty simple. Attach the deck. I know some investors might disagree with that, but or some founders might disagree with that, but like attach the deck. If they look through it and they decide they're not interested, like that saves everyone a lot of time. So yeah, kind of brief email, kind of the high points of like what you're doing, what industry you're in, and then the deck that should speak for itself.
I'm a big believer in attaching the deck, but use DocSend. So attach it in DocSend so you can A, so that they can't share it around, and B, so you can analyze where Simon's spending time. It was super interesting when like the first 5 people I sent my deck to spent like all their time on these same 2 slides. Like, well, these slides need to be earlier up in the deck. So send the deck, but don't send it just in a PDF, because then it's everywhere.
Yeah, I will say though, every investor has their ways of downloading DocSends, but the analytics is very true and very important, and it's something that we work with our companies to actually look at, like where are investors dropping off along that story, or like where they spending the most time. So yeah, like DocSend is great, but you got to believe it's going to be downloaded at some point and probably sent around to some friends, but not to the same extent it would be had.
Yeah, you're stopping. It's happening. You're just slowing the pace of that. Yeah, exactly. Yeah.
Do you, when you get sent a DocSend, does that piss you off, Simon?
No, not at all.
Cool. And then, another question on that. Is there an inside relay or in the industry? You know, I always assumed as a founder that when I sent a deck, it wasn't going to get shared outside the firm, that my hope was that it wouldn't get shared outside the firm. Is that true for you guys? And is that true more generally?
Yeah, so as we're looking to put a syndicate together of different investors, that's when we would want to share it outside the firm, but we would never do that without asking the founder first if that was okay. And in the vast majority of situations, they're like, yeah, absolutely, share the deck, or like, here's like a teaser version of that deck that you can share externally, and then we'll share the full thing when we actually chat with them.
Yeah.
But typically most founders are pretty supportive of that when you're bringing really high quality investors kind of into the conversation.
That's another thing you can also do. Like we would have a teaser deck that was like 8 slides that we would send in that first email, because like maybe we didn't want to share the whole model in the first email because maybe Simon is sharing with other people. And so once you've built that relationship, you're like, okay, I trust this person, then maybe you're able to share more information. So you should just be careful with that.
Dylan, for founders on the call or potential customers, for Lucra, how can they find out more about you or find you?
Yeah. You know, if you're a sports fan or a fan of anything, Lucra has sports and recreational games. You can download our product. Our Android app goes live next week, so we'll be both on the iOS app and now on the Android store in over 45 states. Check us out. You can shoot me an email. I'm Dylan@lucrasports.com. Happy to talk to any founders that are looking for advice. It's part of why I joined this. Is I think it's I guess the biggest piece of advice I could give that I forgot to give is not just talking to a lot of investors, but talking to a lot of other founders. Like I got a lot of great investors from other founders that were like, oh, this is a great person for you to know. And then that led to a no, which led to a no, which led to somebody else that was a yes. And so it's just like, talk to a lot of people who have done this before, get advice, share your connection, and then pay it forward, right? Because that's how you become somebody that somebody wants to help, is when you're also making those introductions. So feel free to reach out. Happy to help. And thanks for having me.
Yeah, 100%. And one thing I'll add to that, like the best intros that we get come from our portfolio founders. So if you have a specific investor that you want to get connected to and you know one of their portfolio founders, like that is 100% the best way in, better than getting introduced from an investor or reaching out cold. But obviously sometimes it's not possible, but when it is, I highly recommend going that route.
Great. Well, thank you both so much. Dylan Robbins and Simon Sokol, appreciate you guys and your time. As I'm sure it's been very valuable for our audience today. And if anybody's interested in learning more about Fulcrum and what we do in our Accelerator program, go to our website, fulcrumventureaccelerator.com. We are accepting early bird applications for our next cohort. Have a great rest of your day, everyone, and good luck out there.
Thanks, everyone.
Thanks everyone.
Thanks all.